Hyperliquid, Hype token, up over 300% in a matter of months. And here's the part nobody wants to admit. The real reason this chart exploded has almost nothing to do with hype, hopium, or another crypto bull run narrative. It's buried in one single line of the Tokenomics document. A line most of you never read. A line that, if you had understood it back in November, would have changed your entire portfolio. And I know some of you watching right now received hype in the airdrop. Free tokens, life-changing money sitting in your wallet. And you sold. You sold at $2, at $5, maybe at $10, and now it's trading at levels that make you sick to look at. If that's you, stay with me, because today I'm going to break down exactly what happened, why it happened, and whether this move is actually over, or whether we're still in the early innings of something much bigger. If you watch this video to the end, you'll understand the buyback mechanism that's quietly turning hype into one of the most aggressive deflationary assets in all of crypto. You'll understand why Wall Street analysts are now comparing this token to early-stage Binance equity. And you'll know exactly what to watch for next. Let's get into it. First, let's set the stage. Hyperliquid is a decentralized perpetuals exchange. On-chain order book. Sub-second execution. No gas fees for traders. It launched its native token, Hype, in late November of last year through what is now considered one of the largest and most generous airdrops in crypto history. Roughly 31% of the total supply distributed directly to users. No VCs, no private rounds, no insider allocation to Silicon Valley funds. That alone made the market pay attention. But the airdrop wasn't the reason for the 300% move. The airdrop was the entry ticket. The real engine is something else entirely. Here's the line most people skipped. Hyperliquid takes the trading fees generated by the protocol, and we're talking about a platform that has done over $1 trillion in cumulative trading volume. And it uses a significant portion of those fees to buy back Hype tokens directly from the open market. Those tokens are then either burned or sent to the assistance fund. Let me repeat that. Real revenue, real fees, real buybacks. Happening every single day, on-chain, transparently, where anyone can verify it. According to on-chain data, the assistance fund alone has accumulated over 25 million Hype tokens through these buybacks. At current prices, we're talking about billions of dollars in value, removed from circulation, funded entirely by organic trading activity. This is not a promise. This is not a roadmap. This is happening right now, block by block. And here's where it gets interesting. Hyperliquid has been generating somewhere between $50 and $90 million in monthly revenue. Annualized, that puts the protocol at over $1 billion in run rate. Compare that to almost any other token in crypto. Most Layer 1s, most DeFi protocols, they don't even come close. Analysts on Wall Street, and yes, even traditional finance desks, are now starting to model Hype the way they once modeled early Binance equity, as a claim on exchange revenue. That's the real reason for the 300% move. Not hype. Not memes, cash flow, buybacks, deflation. A token structure that aligns directly with usage. Now let's talk about who's been quietly accumulating. On-chain analytics firms have flagged several large wallets, some linked to known market makers, some completely anonymous, that have been buying Hype consistently on every dip. We're not talking about retail FOMO. We're talking about wallets that move $5 to $10 million at a time, with the precision of institutional desks. According to reports circulating in the analyst community, some of these buyers are betting that Hype could reach valuations comparable to mid-tier centralized exchanges within the next 12 to 18 months. And this brings us to the second reason most people missed the move: the float. Even though Hype has a large total supply, the actual circulating float is tight. Team tokens are locked. Future emissions are scheduled but transparent. And with the buyback mechanism constantly pulling tokens off the market, you have a situation where demand is structurally increasing while supply is structurally shrinking. That's a textbook setup for a supply shock. And that's exactly what we've witnessed. Let me give you a concrete example. In a single 30-day window earlier this year, Hyperliquid bought back approximately 1% of the entire circulating supply using fee revenue. 1% in 1 month. If that pace continues, and there's no reason to think it won't, given that volumes are growing, not shrinking, you're looking at a token that becomes meaningfully more scarce every single quarter. Now, I want to address the people watching this who sold their airdrop. I know it hurts. You saw free money, you took profit, you did what most rational people would do. But here's what I want you to understand. The market wasn't pricing in the buyback mechanism back in December. Most traders, even sophisticated ones, treated Hype like just another airdrop token. They didn't read the documentation. They didn't model the fee flows. They didn't understand that this wasn't a governance token. It was effectively a cash-flowing asset, disguised as a crypto token. The information was public. The mechanism was disclosed, but the market took months to price it in. That's the gap. That's where the 300% came from. And the question now is it too late? Let me give you the honest answer. The easy money has been made. Anyone telling you Hype is going to do another 10x from here in the next 3 months is selling you something. But the structural story? The story of a decentralized exchange that's eating market share from centralized players, that's generating real revenue, that's running aggressive buybacks? That story is still in the early chapters. Here's what I'd watch going forward. First, monthly trading volume. As long as volumes stay above $500 billion per month, the buyback engine keeps running at full power. Second, the expansion of Hyper-EVM, which opens the door for DeFi protocols to build directly on Hyperliquid's chain. This is the moment where Hype stops being just an exchange token and starts becoming the gas, the collateral, the settlement layer for an entire ecosystem. Third, watch for any signals of institutional custody integration. Once major custodians support Hype, the door opens for funds, family offices, and even ETF wrappers down the line. There are also risks. Let's be honest about them. Regulatory risk is real. The SEC has been aggressive with anything that looks like a security, and a token that distributes protocol revenue is exactly the kind of structure regulators scrutinize. Competition is also intensifying. Other on-chain perpetuals exchanges are launching with similar models. And of course, if crypto enters a deep bear market, trading volumes drop, and the buyback engine loses its fuel. These are not reasons to avoid the token. These are reasons to size your position properly. Let me give you the bigger picture. What Hyperliquid has done, whether you own the token or not, is prove a thesis. The thesis that a decentralized exchange can compete with centralized players on speed, on user experience, on liquidity, and that the value created can flow directly to token holders through transparent, on-chain mechanisms. This is the model that a lot of other projects will try to copy. Some will succeed, most will fail. But Hype was first. Hype has the liquidity, and Hype has the network effect. So when people ask me why Hype pumped 300%, I don't say it was hype. I don't say it was a narrative trade. I say it was the market finally waking up to a tokenomics structure that was sitting in plain sight the entire time. The buyback, the fee burn, the shrinking float, the growing revenue. All of it written down. All of it verifiable. All of it ignored. Until it wasn't. If you sold your airdrop, don't beat yourself up. Learn from it. The next Hyperliquid is being launched somewhere right now. Maybe it's another perpetuals platform. Maybe it's a new layer 2. Maybe it's something nobody is talking about yet. But the lesson is this. Read the tokenomics. Read the fee structure. Ask where the revenue goes. Ask whether the token captures value or just sits on the sidelines. That single habit will save you from missing the next 300% move. And for those of you still holding or thinking about entering, do your own research, size your position based on risk, and remember that even the best assets correct hard along the way. Don't chase green candles. Wait for the structure to give you an entry. That's the real story behind hype. Not magic, not luck, just a tokenomics design that most people didn't bother to read. If this breakdown gave you a new perspective, please hit the like button and subscribe so I can keep bringing you deeper analysis on the trades and tokens that actually matter. Take a close look at what we covered today. Manage your risk carefully, and I'll see you in the next one. Happy investing, everyone.